Most traders jump straight into entries and then wonder why the trade fails. That's why top-down analysis matters. In this video, I'll show you how to do top-down analysis step by step, the right way. First thing I want you to understand is that we always start with the daily time frame. When we look at this structure, we can clearly see a buy-side liquidity sweep. And after that sweep, price starts retracing back into the daily fair value gap. This already gives us a clue that the market is likely to move lower. But obviously, we can't enter a trade on the daily time frame. So next, we drop down to the 4-hour time frame and look for confirmation inside that daily fair value gap. Here, we can see a high getting swept, which tells us that the 4-hour time frame is also bearish. But still, we can't enter on the 4-hour. Then we move down to the 15-minute time frame to look for confirmation. On the 15-minute, we get displacement and a fair value gap forming, which aligns with our higher time frame bias. Now the key thing is that we want to see the same type of manipulation on our entry time frame. So we drop down to the 1-minute time frame and simply wait for a liquidity sweep inside the 15-minute fair value gap. Once we get that sweep along with confirmation, we take the entry and target the opposing side liquidity. Now, one thing you always have to keep in mind is this. Once your higher time frame bias is clear, you must stick to that same bias when looking for entries. And here's why this is important. Let's say this is the 15-minute time frame and we get a liquidity sweep here. If price is expected to move lower on the 15-minute time frame, then it has to move lower on all the lower time frames as well. It's not possible for price to be moving down on the 15-minute, while at the same time moving up on the 1-minute time frame. Lower time frames are simply a reflection of what's happening on the higher time frame. One more thing I like to do is this. Let's say on the daily time frame we have a clear liquidity sweep, and price is currently reacting from a fair value gap. But at the same time, we also have another fair value gap above where the market has already retraced earlier. In these types of market conditions, a lot of traders tend to get confused about direction. But there's no need to overcomplicate it. When we drop down to the 4-hour time frame, the first thing we look for is manipulation. Here, we can clearly see a manipulation happening on the highs, but on the lows, there is no manipulation yet. Because of that, after this sweep, we can expect price to make one more retracement back into that bullish fair value gap on the daily time frame. Only after that manipulation takes place can we expect the market to continue moving higher. What I want you to understand is that even if a fair value gap has already been rebalanced, without manipulation, we have nothing to do in terms of entries. Fair value gaps alone are not enough. We must always see some form of manipulation first, and only then do we look for any bullish or bearish trade opportunities. The most important area where a lot of traders get confused is this. They correctly identify the higher time frame bias, but when they move down to the lower time frame to enter, they keep getting stopped out again and again. The issue is not their bias, it's their timing. What most traders do is they spot a liquidity sweep on a higher time frame, for example on the 4-hour chart, and the moment that sweep happens, they immediately drop down to the lower time frame and start hunting for confirmations. They enter the trade, get stopped out, and then watch price move exactly in the direction they originally expected. The mistake here is thinking that a higher time frame liquidity sweep alone is enough. When liquidity gets swept on a higher time frame, lower time frame confirmations by themselves are not strong enough to hold the trade. Before looking for any lower time frame entries, we must first see a clear and strong displacement on the higher time frame itself. That displacement tells us that the market has actually decided on direction. Only after that do we drop down to the lower time frame for precise entries. This one change alone can save traders from a lot of unnecessary stopouts. So coming to this example, we are on the daily time frame, and the first thing we have to do is identify our bias. If we look closely, we can see that we have a sell-side liquidity sweep on the daily time frame. After that, we can see that currently we are retracing back to a daily fair value gap. But you might think, why are we expecting a move to the upside when we also have a bearish fair value gap here? The answer is simple: because we have a manipulation here. What I told earlier is that without manipulation, fair value gaps mean nothing. We can expect a move only if there is some sort of manipulation. So our bias on the daily time frame is bullish. Dropping down to the 4-hour time frame, here we can see that we had a manipulation on this daily fair value gap. You can see here that we have manipulation on the lower side, but we don't have any manipulation on the highs. That tells us that the market could move higher. Now we also have a 4-hour bullish fair value gap here, where price is currently retracing back. But we don't have any manipulation on this gap, so our bias is also bullish on the 4-hour time frame. Now dropping down to the 15-minute time frame, here we can see liquidity getting swept on the 4-hour fair value gap. What we will do is wait for some displacement on the 15-minute time frame instead of directly looking at the lower time frame. So now we have displacement back inside the range. Now we will drop down to the 1-minute time frame. Here, we have a fair value gap and a bullish change in state of delivery. So we will enter right here, place our stop at the previous lows, and for the target, we will use the 15-minute buy-side liquidity. The market starts moving to the upside and gives us our target. This is the exact framework I am telling you to follow. Now, one more thing I want to clear is that most traders think that once we have a buy-side liquidity sweep, we can take short positions. They think, now let's wait for displacement. Now we have displacement on the 15-minute, so let's try to enter on the lower time frame. Here we have a market structure shift to the downside, and on top of that, we also have a fair value gap. So let's just say you enter here and target these 1-minute lows in this trade. The market then triggers your order and goes sideways just to stop you out in the end. That's why I told you to stick with the higher time frame bias. What happens is this. Suppose your higher time frame looks something like this and it is clearly bullish. You might see some manipulation against the bias on the lower time frame, but in the end, the lower time frame also has to move in sync with the higher time frame, which causes you to get stopped out. This happens because when the higher time frame is bullish, there are a lot of fair value gaps in the range that hold the price and prevent it from moving to the downside. Exactly like we have the higher time frame fair value gap here, which held the price and kept it moving upward by stopping out traders who were against the higher time frame bias.
That's it for this video. I hope this breakdown helped you better understand liquidity, entries, and why trades get stopped out, and that it improves your overall trading performance. If you found value in this video, make sure to like, share, and subscribe for more ICT concepts, market structure, and real chart breakdowns. You can also join my Discord trading community for daily discussions and learning. If you're interested in mentorship or prop firm discount offers, all the links are in the description below. Thanks for watching, and I'll see you in the next video.